Hey everyone, and welcome. Today we are going to pull back the curtain on what might be one of the most powerful and honestly kind of overlooked indicators in the entire financial world. We are talking about the PMI.
And a big welcome to you from our friends and partners here at ValueVest Daily.
Okay, let's just jump right in. What if I told you there's a single number, just one, that gets released every month, and it can give you a massive clue about where the economy and the stock market is about to go? It almost sounds like a cheat code for investing, right? Well, it's very, very real.
That number is the Purchasing Managers Index, or PMI for short. The easiest way to think about it is like taking the pulse of the economy. See, it's a survey of the people who are right there on the front lines of business, the purchasing managers who are making the big buying decisions every single day. And it's important to know there are two main flavors: manufacturing PMI for the goods sector and services PMI for the much larger services side. And because it's measuring what they think will happen with future orders and production, it's a leading indicator. It's not looking in the rearview mirror, it's looking out the front windshield.
So, here's our game plan. First, we'll break down exactly what the PMI is. Then, we'll see how it actually impacts your portfolio. After that, we'll look at some jaw-dropping historical examples. Then, we'll get into how you can use it. And finally, we'll take a peek at what it's signaling for 2026. So, first things first, what exactly is this indicator? Well, at its core, it's actually incredibly simple. It all boils down to one single magic number.
And that number is 50. That's it, 50. This is the big one, the center line. If you only remember one thing from this whole explainer, make it this number. Everything about the PMI report hinges on this single threshold.
So, here's the crucial part, the rule of 50. If a PMI reading comes in above 50, it means that part of the economy is expanding. Businesses are getting more orders, they're producing more stuff, and things are generally looking up. But if it drops below 50, well, that's your signal for contraction. Business conditions are getting worse. It's really that simple, a clear binary signal of economic health.
Now here's where it gets really interesting for us as investors. How does this economic pulse translate directly into how our stocks perform? I mean, how can a survey number actually move markets?
It is all about one word: expectations. The stock market is basically a giant expectations machine. The PMI gives Wall Street an early peek, a heads up on how healthy the economy really is, and that shapes what everyone believes is going to happen next with company profits. So think about it. A surprisingly strong PMI number? Boom, confidence soars, and you can get a wave of buying. On the flip side, a weak number sparks fear, and that can lead to a major sell-off.
And listen, this isn't just a vague theory. The data is crystal clear. The quarterly average of the global PMI has a stunning 67% correlation with the annual changes in global stock prices. That is an incredibly powerful link, making it one of the most reliable indicators you can follow.
But the true power of the PMI really comes alive when we look back at some major market turning points. History gives us some absolutely incredible lessons on just how predictive this can be.
Let's go to a recent and pretty dramatic example, the COVID crash. In February of 2020, the PMI was stable, just hanging out around 50. 2 months later, as the world went into lockdown, it absolutely plummeted to 41.5. That was a clear, flashing red light signaling a deep economic contraction. And in that exact same month, the market reacted. The S&P 500 dropped hard, falling right in line with the PMI's warning shot. And this pattern is not a one-off. Just look back at the 2008 financial crisis. The PMI hit rock bottom at 35.6 in December of that year. But here's the key insight. That trough, that lowest point, was the signal that the worst was almost over, and it came right before a sharp rebound. Why? Because markets are always looking forward. The moment the PMI stopped getting worse, it was a sign that a recovery, no matter how far away, was on the horizon. In both of these huge crises, the PMI acted as a real-time barometer for both the pain and the turning point. Okay, so we know the PMI is a seriously powerful indicator, but the big question is, how can you actually use this information to your advantage? Well, this is where a really smart strategy called sector rotation comes in. You see, the market isn't just one giant thing. It's made up of different slices, or sectors. You've got your cyclical sectors. Think industrials, technology. These are the companies that do great when the economy is booming. Then you have defensive sectors, like utilities and healthcare. These are more stable because, well, people need their services no matter what the economy is doing. The PMI helps you figure out which group might be about to get the spotlight. So here's a simple framework. When you see the PMI consistently rising above that magic number 50, it's a signal that the economy is heating up. And in that environment, those cyclical sectors often outperform. But when you see the PMI falling below 50, that's a warning of a slowdown. During those times, investors often look for safety, and those defensive sectors tend to provide more stability. It's a way to try and align your portfolio with the big economic tides.
All right, let's bring it all home to the present day and look ahead. What is the PMI signaling for the near future? Specifically, what's the story as we start looking towards 2026?
Looking at the latest data here, you can see a pretty clear story. Both the US and the Eurozone are still hovering just below that 50 mark, which signals some lingering weakness. But the trend for 2026 is one of gradual improvement, a slow climb back towards expansion. So, cautious optimism is the name of the game. Meanwhile, the overall global PMI is already just a hair above 50, suggesting that the worldwide recovery could really start to pick up steam as we move through the year.
So, to wrap this all up in a neat little bow, the PMI is your forward-looking economic dashboard. Just remember that magic number, 50. History shows a powerful link between its moves and the stock market. You can use its signals to get a better handle on sector rotation. And finally, the outlook for 2026 is looking like one of cautious optimism.
And as always, a quick reminder that this content is for informational purposes only. It is not financial or tax advice.
If you got some value out of this, please do us a huge favor and subscribe, like, and share Value Vest Daily. It really helps us bring you more daily learning opportunities before you put your money to work.
And one more thing, we want to hear from you. What are some of the high-risk, high-reward opportunities you're curious about right now? Let us know in the comments if you want us to do a deep dive on any specific ideas. Thanks for watching.